That's great.
Right, I think we can start. Good afternoon, everyone, and welcome to Mondays at Murdoch. Thank you so much for joining us today. As you all know, and I've been waiting for a long time for this amazing session, an introduction and a beginner's guide to trading. So, of course, trading is something which we think is extremely complex, and many of us are interested in knowing how it works. Is it something which any person can indulge in? So we have all of that for you today with our guest speaker, and I will do a very quick introduction about Giles Coghlan. Giles, thank you so much for being here today. Really appreciate you taking the time out for this.
Thank you, Megha. It's lovely to be here.
Yes. So Giles Coghlan is the chief currency analyst at HYCM. He joined the company in 2018, and he's played a key role in providing his expertise to HYCM's investors. He has more than 10 years of experience in trading, and he's also committed to helping traders by sharing real-time analysis and actionable information on the latest moves in the currency, equity, and commodity markets. Giles is also featured on so many different media outlets like City AM, Yahoo Finance, Morningstar, Business Leader, Kuwait Times, Forbes Middle East, Money Observer, Global Banking and Finance, World Finance, to name a few. He also regularly appears on CNBC Arabia for featured commentary on market-moving news and contributes to major Forex media such as Investing.com, FX Empire, Daily Forex, FX Street, Leparade, and Finance Magnets. So Giles is, of course, gifted and engaging communicator. He does so many of these amazing seminars, online webinars, and trading workshops all over the world. And he's here with us from the UK today. And thank you so much again, Giles, for joining us. And I really look forward to learning a lot today. And I think we have about 20 participants, and I think a few more would jump in, but it's over to you now.
Thank you very much, Megha. That's a lovely introduction, and I've really been looking forward to this session. Before I get going, can you just let me know? I am sharing my screen. Can you see my screen? HYCM, an introduction to trading.
Yes, I can see a screen, but I think you need to make it like the slideshow version. We can see, like, I can even see the panel on the right.
Oh, that's great. I'll just move the panel slightly off.
Okay.
I'll use the panel because it helps me as I'm going along, so I can see what's coming. So you'll have to put up with that. My apologies.
No worries. I think it's bright and clear, and I think everyone can see it. And
that's super. Lovely.
Okay. Yeah, thank you.
Right. Well, I'm really looking forward to this session. There's a couple of things I just want to say about myself before I do get going, as well as the other things that Megha introduced me for this morning, or this afternoon for you guys. It's your afternoon, isn't it? About 4 or 5 o'clock. What I will also share is some of the trades that I've been taking in a fund that I'm setting up here in the UK. So I'll also share with you not only a beginner's guide to trading, but I'll show you how I put some of these principles into practice in my own trading for my own account. So I hope that just makes it a little bit more interesting for you as we go along. In terms of what we're going to do today, I have to say that this is designed to be a beginner's guide to currency trading. So I'm going to try to really give you the fundamental basis for currency trading. Obviously, there is a huge amount that could be said. And as I have just an hour, I'm going to condense that down, but I will also give you opportunity to ask questions. So if you have a question during the webinar, I'll have 2 or 3 option times where I'll just pause. And if you type your questions in the Q&A box, I will get through to answering as many of those as I can. And don't worry about asking questions. Don't worry about asking silly questions. I'm a big believer in asking silly questions because I think the more silly questions you ask, the quicker you learn. So don't be afraid about asking anything that you think is silly at all. So if there's something that's bugging you, you want to understand it, please do let me know, and I'll be delighted to help you if I can. We'll be looking at what are the main drivers of currencies. I'll also introduce the king of currencies to help you have a bit of a framework to understand currencies as a whole. I'll show you what drives currencies. I'll also show you some of the key relationships between commodities, that's things like copper and oil, and currencies, and the major indices, things like the FTSE 100 and the S&P 500. And I'll also intersperse it with some of my trades this year. So I hope it's going to be an interesting snapshot. Don't forget, use the question and answer panel as we go along through the session. So let's look at the very first factor, is what drives the currency markets. Now, before we really go into answering that, I want to introduce to you the king of currencies. There's my first typo for the day. Now, the king of currencies is the US dollar. So you have to remember that whenever we're looking at currencies, the most influential currency is the US dollar. About 70% of all currency transactions that take place in the world on any given day, about 70% of those involve the US dollar. Some smaller countries will decide to trade in US dollars and to fix their currency against the US dollar rather than have their own currency. The reason they do that is because the US dollar is so widely traded, it gives an enormous amount of flexibility and stability. So the US dollar sits among currencies as a king among princes. Once you understand that, that's a very key concept to begin with your conceptual framework of currencies. Now, part of the reason for the prominence of the US dollar is due to the prominence, obviously, of the United States. If you just look at the GDP as a breakdown of the entire globe, what you can see is there's two major currencies, two major countries that really dominate the landscape. That's the US, China. So the three largest trading blocks in the world are the US, China, and Europe, in that order. US is number one, China's number two, Europe is now number three, and China has just overtaken the European trading bloc. So sitting on top with the crown is the US. So a key part of understanding the framework of the world is the preeminence and the importance of the US dollar. So here's my first question for you. If the US dollar is the king of currencies and the most requested currency, what do you think happened to the US dollar during the coronavirus crisis? Here's a question, see if you can answer it. I'll ask the question again. If the US dollar is the most important currency in the world, in times of crisis, like we have with the COVID-19, what do you think happened to the US dollar? And if you just type your answer in the chat or the Q&A box, okay, we've had someone say it would drop. Do we have any other answers? This is during the crisis itself, when equity markets were selling off very heavily and people were very nervous. Okay, very good. Thank you for those of you who've answered. We have about 4 or 5 drops. We have a couple of rises, and we have one, it depends on inflation. So first of all, that's great. I've got about 8 or 9, 10 responses. So thank you very much for your responses. Well, what happened is the US dollar rose at the height of the coronavirus crisis. And here's the reason. If there's a crisis going on, you want to have the most liquid currency in your possession. So there was a sudden, strong rush and demand for the US dollar. The US dollar is known as a safe haven currency in times of severe crisis. Some countries have their debt denominated in US dollars. So during the crisis, there was a very, very strong desire for US dollar buyers. And so this is one of the first trades that I took in March with my fund. I took some dollar index longs on this US dollar safe haven strength. So going into March, you could suddenly see what was happening. There was very strong safe haven demand. And you can see here that I took 3 positions, and the 3 positions, I closed one at about 102. I closed the second out at about just 102.20 odd. And I left a third running at break even at the time. So that was just a very simple trade that I took at the start of the year on that US dollar safe haven strength. So if the US dollar is the king of currencies, what is the Federal Reserve? You have to complete that sentence. If the US dollar is the king of currencies, the Federal Reserve is what do you think? First of all, what is the Federal Reserve? Good try, Yara. I like your thinking. Yes, we have the answer. Kevin, well done. Kevin finished this sentence for me, and he said that if the US dollar is the king of currencies, the Federal Reserve is the king of banks. So, Kevin, give yourself a gold star. Very, very good. Thank you, Yara and Simi, for your answers as well. They're very excellent. Now, this is the very first thing to understand about what drives currencies. Central bank monetary policy drives currencies. So, monetary policy comes from a country's central bank or the government. Now, at the moment, we've been seeing monetary policy coming out of central banks and governments. So we've been seeing monetary stimulus from the central bank, and we've been seeing fiscal stimulus from the governments. In the normal run of things, in other words, when we haven't got COVID-19, the main driver of monetary policy is the central bank. Because the central bank's job is to keep currency stable and to ensure that exchange rates stay at a stable, predictable level for the country's exporters and importers. The last thing a central bank wants to see is currencies going up and down with large volatile price swings. How can traders and exporters trade if 1 minute they have to charge an extra 10% for their product and then an extra 20% and they drop it 20%? A central bank wants to ensure stability for their currency. Now, the way central banks work is the monetary policy will move a currency like an engine moves a car. So just imagine this conceptual framework. If you're thinking, will the path of a currency go up or will the path of a currency go down? Well, it's the central bank's monetary policy that ultimately decides on the direction of that country's currency. The central bank can make decisions that change the movement of the currency. So just if you imagine a car, and if the car doesn't have an engine, it won't move. A currency is driven by the engine of the central bank. So as you can imagine, for a currency trader like myself, the central bank's policy decisions are things that I study all the time. I'm constantly reading, evaluating, and assessing what the central bank's monetary policy is. And the central bank, when the central bank's making a decision, it looks at 4 key areas. It looks at the production of the country, the employment of the country. So production is things like how much manufacturing, is the manufacturing increasing, is it decreasing? What's the services industry like? If you look at, something like the UK, we have a very service-driven economy. So services are more important than manufacturing. And each of the different countries have different breakdowns of how their production takes place. Are they a service-led country? Are they a manufacturing-driven country? And all these different breakdowns matter differently for different central banks. Then employment. How many people are in work? How many people are out of work? And what what wages are those people being employed? Central banks are focusing on these factors. The two most important indicators are growth and inflation. So growth is how much production is the country making, and inflation just concerns the cost of goods and services going up over time. And virtually all central banks have a specific or general inflation level they're trying to achieve. Most major central banks in the world are looking for an inflation level of around 2%. That's what they're trying to achieve. And obviously at the moment, inflation is suppressed around all the major world central banks. We have very low inflation levels. Now, of these two factors, growth and inflation are the most important out of production and employment. And the two that's most important out of growth and inflation, the most important is inflation. So inflation is probably the key indicator that can change monetary policy. So now you can see, as a currency trader, the key things I'm looking at is central bank policy decisions, and I'm looking at the nation's economic data points, growth, inflation, and production and employment, with a particular eye to inflation. Now, a little advanced tip for you. This is a beginner's course, but I'll give you an advanced tip. Many beginning traders, particularly from a retail perspective, when they want to learn to trade, they will understand this point, and they will understand that these economic data points are important for a central bank. But they'll make a crucial mistake. What they'll do is they'll think that all these points are equally important at all times. So production, employment, and growth and inflation are always important at all times. The reality is they're not. These different indicators are more or less important to a central bank at different times. So let me give you a real world example. I've been looking at the Reserve Bank of Australia's last central bank decision. They made their central bank decision last week. And in the central bank decision, they were paying very careful attention to employment. They wanted to see employment levels pick up. So if the central bank are telling you that they're focusing very carefully on employment, does employment become more important or less important for moving a currency? What do you think? If a central bank, like the Reserve Bank of Australia, focuses on employment in its statement, if it tells all the world's investors and all the world's traders that it's focusing very carefully on employment, how important does how important does the labour data become? What do you think? Very important or less important? Yeah, Coghlan, excellent. It becomes more important. Yeah, Simi, Maria, excellent. Even more important, very important. Cerinthi, excellent. Well done. You've engaged. If you understand that one point, you have already understood about 90% more than many people when they're starting and they're learning to trade. Central banks focus on different points at different times. Myself, as a trader, as an investor, when I hear a central bank tell me that they're focusing on employment data, I will then look at the employment data, and I'm expecting volatility around that currency. So say, for example, I get the next economic employment data out of the Australian dollar, and that data is very strong, I will be buying the Australian dollar. I can tell you that almost instantly now, because I know that the market's focused on that, because the central bank is focused on that. That's good news for the Australian economy. Buy the Australian dollar, I would be expecting some short-term upside. Well done. Excellent, I've been impressed. You got that quickly. So now we've established what drives a currency, and that's what drives a currency is the central bank policy. We also have had fiscal stimulus, but we'll leave that to one side for now. But the major driver in normal times is the monetary policy of the central banks. The central banks have 4 tools. They have 4 tools in their toolbox to what? Ensure price stability. Remember, that's what a central bank wants. It wants prices to be smooth. It doesn't want to surprise the market because it wants that smooth price movement. It doesn't want to see this. So these are the four tools that the central bank has. They have interest rates, price control, language, and quantitative easing. They are the four major tools that a central bank to use. Now, because this is a beginner's and introductory guide, I'm just going to briefly cover some of the most important points here. There is a lot more that I could say, and I do run a number of different courses to help traders and beginner traders understand this in more depth. So this is just a taster to give you an idea of how the central banks work. The number one tool, the top thing that I am always following is interest rates. Now, the central bank sets the rate that banks are charged for borrowing money from the central bank, and it's the primary tool used to control inflation. If inflation is getting out of control, the only tool the central bank has is to increase interest rates. Now, low interest rates obviously create low borrowing costs and a positive environment for business. So what do you think at the moment central banks have been doing during the coronavirus crisis? Have they been raising interest rates or dropping them? What do you think? You tell me. Excellent. Bhargav, excellent. Simi, excellent. Laura, well done. Pragabar, think again. Alwyn, Asan, correct. Sarinthi, correct. Well done. That's a nice flurry of correct answers. Central banks have been cutting interest rates because they want to keep borrowing costs low, and they want to encourage companies to borrow money because it's a positive environment for businesses. So central banks, as soon as central banks detect that their economy is under strain, they'll want to drop interest rates to support the economy. So that's why central banks around the world started cutting interest rates in response to COVID-19. Now, normally, these interest rate decisions, there's maybe 8 to 12 for each central bank across the year. Some banks meet once a month, some meet once a quarter, and all central banks tell the market exactly what's happening with their interest rate decisions. So obviously, with COVID-19 and the market really wanting to support economies, remember, low interest rates means debt becomes less expensive for a country, for a company. It also means that companies can borrow more at very low rates. You can borrow money now as a company at incredibly low rates, and it's to support growth. So I'll show you how one more question. When a country cuts its interest rates, what happens to the value of that currency? Does the value of the currency go up or down? A country cuts its interest rate. Does the value of that currency go up or down? Cliven, correct. Abdul, think again. Simi, it depends. That's a good answer. But Simi, if you just look at it in the pure abstract, if a central bank cuts its interest rate, does it go up or down? Yara, down, correct. Arsan, think again. Maria, no. Gabrielle, down. Yeah, excellent. Hey, this is great engagement. Thank you all very much for engaging with me, and we're getting some great answers. The currency goes down. Bhargav, it doesn't really depend on its inflation. The key issue here is once a central bank cuts its interest rate, it means that there's less interest for holding that currency. So look at the major currencies. If all of a sudden the Reserve Bank of Australia starts cutting its interest rates, that means that my money that's in Australian dollars, that's in the bank, I think, well, you know, the interest rate is lower now because the central bank cut the interest rate. So I get less money for having my money in Australian dollars. So I will remove the Australian dollar from Australia. And if I'm moving the Australian dollar from Australia and I'm bringing it back to the UK, I have to change it from Australian dollars into Great British pounds. So the value of the Australian dollar goes down. If the opposite happened, if all of a sudden the Australian dollar, the Reserve Bank of Australia, say they increase interest rates by 1%, I think fantastic. I can get an extra 1% if I change my pounds into Australian dollars, and then I would buy the Australian dollar. So with my fund, when we had the Bank of Canada, they had a surprise interest rate decision. And so you can see here, I sold the Canadian dollar on the 5th of March, and I held it for 1 day as it dropped 137 points. Now, two things to say about this. Which has more impact? If a central bank tells you 6 weeks in advance that it's going to cut interest rates, or if a central bank surprises the market and surprisingly cuts interest rates, which would have more reaction? The surprise, or if the market let you know over 6 weeks? Which one? Srinthi, correct. Yara, correct. Bhargav, think again. Simi, correct. Gabrielle, correct. Prabhagar, Abdul, correct, correct. Well done. Of course, it's a surprise. Key principle for currency trading. The less expected an event is, the greater the impact. Okay? You might have heard of buy the rumor, sell the fact. This is the kind of way that currency traders trade. I'm always looking 6 weeks, 8 months, 6 weeks, 6 months in advance. I'm looking as far advanced as possible. So often, by the time an event happens, the move's already happened. I'm always looking ahead, looking ahead, looking ahead. So this is another mistake that beginner traders make. They'll see, the central bank cut interest rates. But hang on, the Canadian dollar went up. And I thought Giles said that the Canadian dollar would go down. If it's expected, you'll see the moves happen before the event. Sell the rumor, buy the fact. Do you see it's anticipation, isn't it? It's all about anticipation. It's like if I said to you, come round to my house, we're gonna have a lovely meal. We're gonna go out and we're gonna have a night, we're gonna go to a top restaurant, we're gonna have a fantastic evening. When do you buy the clothes to go out for the meal? If you wanted to get a new dress or a new suit, you buy the clothes a couple of weeks in advance, don't you? It's the same kind of thinking with currency trading. You would buy or sell the currency in advance of the decision. So when it's a surprise, great. That's music to my ears as a currency trader, because you can see here, the Canadian dollar, they made that decision. And you see how the price went one way? The price just dropped. This was me doing exactly the same with the Canadian dollar against the Swiss franc. Do you see that? 145 points. The trade went one way. That's over a day and a half. Here we had exactly the same, but I'm buying gold on US dollar weakness. So the Federal Reserve had a surprise interest rate cut. Gold is often used as a hedge against the dollar. So as soon as the Federal Reserve cut interest rates, I knew that was going to be a strong increase in gold. And you can see here, I got 1640 up to about 1680. So I made about $40 on the ounce for gold. And I did exactly the same, buying silver on the surprise interest rate cut from the Federal Reserve. Got in a little bit late here. You can see the initial move happened, but I got out for a little profit there on silver. So these are trades that I took during in my fund this year, and I've just completed the year for the fund, and I've sort of made 21% profit, just under, with a 4.5% drawdown. So that's a very strong first year for me. And these are the kind of trades that I'm taking without using leverage. That's another key mistake that beginner traders use. They risk far too much money and they end up getting some trading decisions wrong, which ruins them. It's one of the key concepts that I teach clients at HYCM and clients who I instruct on a daily basis with financial source. I teach them how to manage risk. And if you don't understand how to manage risk in a professional and very good way, you should never begin trading in the ways that I'm outlining it here, because you will lose all your money. It's just a question of when. So I teach investors how to avoid that, how to avoid those mistakes, but don't try to imitate what you're seeing me do here, because it's a lot harder to do, and it takes quite a few years to begin to develop these skills. So the other tool that central bank uses, language. Now, I can tell that you're a good group, you'll understand this. Remember, the central bank wants to avoid surprising the markets, so it makes statements about where the prices and the future path of interest rates are. So a central bank will tell you what they're intending to do, okay? So here's a very simple thing that I've used as an example. You see here, this was an interest rate decision that the Reserve Bank of New Zealand made. They said, we expect to keep the official cash rate, that's the interest rate, at this level through 2019 and 2020, longer than we projected in our May statement. So they said they're going to keep the interest rate at their level for longer than expected. They had been expecting otherwise to be going up. They then said it could be going up or down. And you can see immediately, you see that the New Zealand dollar lost value. That's the Aussie New Zealand dollar, and it's because of that central bank message. Here is the Reserve Bank of Australia. This was a trade I took last week, which I recorded for you. You can see that at the last interest rate decision, 2nd of December 2020, the Reserve Bank of Australia adopted a more optimistic tone. They were far more upbeat than they had been. And although they didn't change the interest rate decision, they didn't change anything they were doing, they were just more upbeat. They were more optimistic. And so I thought, well, that's great, because that means I expect the Australian dollar to increase in value against the New Zealand dollar. And you can see these are my trades I took. These are very small positions that I took, but nonetheless, I made quite a decent profit for a small trade to the upside here, position 1, and closed out upside there, position 2. That was on the Reserve Bank of Australia, just being more optimistic, sounding more upbeat. And obviously, why? Can anyone tell me what reason the Reserve Bank of Australia might have been more optimistic going into their last interest rate decision? Can anyone give me a reason? Why might the Reserve Bank of Australia be more optimistic? Okay, good try, Bugger. Let me give you a clue. What news have we had since early November? What news did we have? Major global financial news that everyone would have heard about, even if you're not following the markets daily. Cliven, well done. Excellent. The coronavirus vaccine news. Well done, Yara. Well done, Ghazala. Brilliant. So I knew going into that meeting, I expect the Reserve Bank of Australia will be more optimistic. So I was kind of expecting it as well. And the unemployment was slightly better than they expected. The fall in GT was slightly better, GDP better than expected. So I was expecting a little bit more optimism. Lo and behold, I got it. Paired it against the New Zealand dollar, because I knew that was relatively speaking going to be probably weak compared to the Australian dollar on that news, and took some upside on the Aussie dollar, New Zealand dollar. Great. Now over to you. We've looked at what drives a currency. You now understand that a central bank's monetary policy is the primary driver of a currency. You've seen the indicators a central bank looks at. You've seen the tools a central bank has. Obviously, there's much more I could say, and this would take a lot longer to unpack. This is a beginner's study session, so I hope that helps. I've got a few moments for questions and answers. Please do ask your Q&A now if you have one. Okay, super. No questions. Okay, Bhargav says, so the effect the news of COVID vaccine had on the Australian dollar, was it actually a surprise? Yeah, very good point. Was it a surprise? No. But what was a bit of a surprise was that the RBA was more optimistic, okay? Because the fact that the RBA signaled a little bit more optimism, it was a number of different factors. It was not a surprise, it's a slight shift, a slight change, okay? Maria, what exactly does selling your money mean? Okay, so let me show you. When it's a very good question. Let me show you. Okay, so when you're selling the Canadian dollar, you sell currencies against another currency. So when I'm selling the Canadian dollar Swiss franc, what I'm actually doing is I'm actually simultaneously selling the Canadian dollar and buying the Swiss franc, okay? So it's not just selling the Canadian dollar, but I'm also buying the Swiss franc. You trade currencies as a pair. So you trade the pound against the US dollar, the pound against the euro, the Australia against the New Zealand dollar. So you're always, at the same time as selling one, you're buying the other. So this is selling the Canadian dollar while buying the Swiss franc at the same time. It's a confusing concept at first, Maria, and your question reminds me how I just take it for granted that I do this every day. But the key thing to realize is you're not dealing with the currency in isolation, you're pairing it with another one. So that can help you. Okay, the second part of the seminar we're looking at today, you're welcome, Maria. The second part of the seminar today is how commodities impact currencies. Commodities are things like copper, oil, silver, gold, iron ore. These are commodities. And commodities have a relationship to currencies. When you're looking at the global markets, don't think of the markets like this. Equities here, bonds there, currencies here. Instead, think of the markets like a spider web. You know the spider web? If you pull the spider web on this side, that side of the spider web shakes. It's exactly the same with the financial markets. If something happens in the commodities markets, it'll be felt in the currencies markets. If something happens in the bond markets, you'll see it in the equity markets as well. So the financial markets are all interrelated and money is constantly flowing around these markets and they interrelate to each other. So in this little section, I'll just give you a very quick rundown, just so you understand that they do happen. It's a beginner's guide, so I want you to understand that it does happen. So first of all, the Canadian dollar is impacted by oil prices. So Canada is a very oil-dependent nation. So nations which are very oil-dependent, Russia is very oil-dependent, one of the petro currencies. Norway is very oil-dependent. The Canadian dollar is very oil-dependent. So this means that when oil prices drop, you can see this is the Canadian dollar index. You can see as oil prices drop, the Canadian dollar drops. Look, as oil prices rise, the Canadian dollar rises. So that means anytime I'm looking to trade the Canadian dollar, what am I always looking at? This relationship is around 96% inverse correlation with US oil. So the US dollar and the Canadian dollar, because Canada has these huge oil sands and they export virtually all their oil to the US. So the US dollar Canadian dollar currency pair has a 96% inverse correlation with US oil. So in other words, when US oil goes up, US dollar CAD goes down. When US oil goes down, the purple line, US dollar CAD goes up. So whenever I'm trading the Canadian dollar, I'm always looking at the path of the US oil at the same time, okay? So it's a very simple relationship. When oil is up, the purple line, US dollar CAD is down. When oil is down, US dollar CAD is up. Now, these correlations are very good During the corona crisis, because of the strong safe haven demand of the US dollar, this correlation broke down a little bit in the last 6 to 7 months. So this correlation hasn't been as tight as it normally is. Now, as a currency trader, that's something I'm very tuned into, and you notice that as you go along. For those of you who are new, this is a good relationship to understand. And once we're out of coronavirus completely, this correlation ought to pick up again. So another key commodity to look at is the Australian dollar. Bugger, I will have another opportunity for question and answers. So in the next Q&A session, if you just put your question in, I'll get to that question. So commodities, this is how they impact currencies, okay? So the Australian dollar is one of the world's biggest gold producers. And what you see with the Australian dollar is that when the Australian dollar rises, it also tracks gold prices higher. So you see quite a strong relationship between gold and the Australian dollar. You also see a strong relationship between copper and the Chinese economy. Now remember, China is really the manufacturing hub of the world. China manufactures a huge amount, and Chinese manufacturing really drives global growth. Now, in order to manufacture, one of the key commodities is copper. Now, copper has a nickname. Copper's called Dr. Copper because it tells you the health of the global economy. So when copper's rising, that gives you a good indication that expectations the global economy will rise. So if I just quickly show you copper, I'm going to quickly show you the copper chart over the last few weeks since the vaccine. Let me just show you this. Okay, let me just change my screen. There we go. Now you should be able to see here. Now, if you look here, you can see the price of copper. Remember, we had the Pfizer-BioNTech vaccine news on the 9th of November. So this was the vaccine news here, 9th of November, and you can see that copper has just been ripping higher on that positive news. You can see here that after March, many traders, they could see that eventually a vaccine is going to come. Eventually the world's going to get back to normal. So copper is trading at a discount. We also had copper mines because of COVID-19. Some copper mines were shutting down. So there was less physical supply of copper, boosting prices even higher. And you can see, look, we've had from March's lows around 2 up to nearly 3.5 at current prices. A huge rip higher in copper. So what we see here is that copper is indicating that the world economy should be getting back into gear and should be moving back into its, into growth coming into the following year. Looking here at the dollar index, we'll just have a quick look at the dollar. Remember, I shared it's the king of currencies. We saw that very strong bid in dollar on the impact of the coronavirus crisis. Then we had a huge amount of dollar weakening via quantitative easing, which is the printing of digital money. And that just weakened the dollar as the Federal Reserve essentially said that they were going to have virtually unlimited digital money being printed, just weakened the dollar. And we're seeing dollar weakness at the moment, which we're expected to see well into next year. So the dollar is expected to be weaker coming into the year. Right, we'll go back to our presentation. Just quickly wanted to show you that with copper. The Australian dollar and copper have around a 70% correlation. The Australian dollar has a key connection to global growth. Australia, about 30% of Australia's GDP comes from its trade with China. So when China is growing, it means global growth is going to be growing, and the Australian dollar also rises. You see an increase in commodity use, iron ore, copper. That all lifts the Australian dollar. Australia exports a huge amount of iron ore. Much of that goes to China. And so when the world is recovering, you start to see the Australian dollar rising as well. So what do you think has been happening to the Australian dollar after the last few weeks and months? Do you think the Australian dollar has been rising or falling? What do you think? If copper's going up, if iron ore is going up, if the Yara, correct. Maria, correct. Well done. Pragabar, Sarinthi, excellent. Very, very good. And I'll show you this on the screen. Let me just change the screen over. You can see here. See, since March and April, the Australian dollar has been strongly rising. And you can see I have a bullish bias on the Australian dollar. I am inclined to buy the Australian dollar for these following reasons here, part of my instructions, which I do for other traders. Well done. Good work, everybody. So here's a few trades that I took on commodities over the last year. Gold had a very strong upside bias around May of this year. Because of the very low interest rates, and because the Federal Reserve expects to keep interest rates very low, and because gold is often seen as a recession hedge, so in times of recession, gold tends to rise, I had a predisposition to buy gold. So here's 3 gold positions I took. We had a technical trading pattern. See the price is coiling up? What happens to a spring when you compress it? What happens when you let go? It expands. So this is the principle here. Yeah, it rises and jumps. Exactly. So you can see here, I had a bias to buy gold. This is the March fall. You saw a symmetrical triangle, a key trading pattern. And I thought, oh, hang on, this is breaking to the upside. Even if it drops, I'm expecting buyers. So just took 3 positions long on gold. And my second best trade of the year was gold. I made just about 6-7%. I made 7% of my account on one gold trade a year. And my best trade of the year was a big surprise to me, was Bitcoin, which I recently closed out. This again is gold strength. See that trend line break? I had 3 positions running higher, 1, 2, then those 2, 3 at break even. Just a slight break of that trend line. As soon as we went above this level, I had a fundamental bias, and this was in July. So I've been looking at buying gold. And again, silver long, this was in sort of June time. I went long on this very simple trend line break to the upside. So you can see that, you know, some great opportunities in commodities during this year. So my fund has been supported a lot by that. We'll quickly look at how indices impact currencies. Just run through. Okay, indices. So first of all, what are equities? Equities are stocks and shares of a company. And if you buy an equity, it means an investor is buying partial ownership of a company. Equities are considered a riskier asset than bonds, because if you're investing in an equity, you tend to be investing in one company or one share. If you buy a bond, you'll often buy a government bond, so you're investing in a whole nation. So equities are seen as riskier than bonds. Now, an index is a group of equities or a group of stocks. So for example, one of the most popular indices is the S&P 500, and that's the 500 largest big cap companies in the US. So when you buy and sell shares in the S&P 500, you're buying and selling shares in all 500 of the companies of the index, okay? So I'm currently long the S&P 500. I've been buying S&P 500 shares via the futures markets because you tend to get a strong rally in equities towards the end of the month. So the most popular indices around the world, S&P 500, FTSE, Dow Jones, French 40, DAX 30, Nikkei 225. You've probably heard of these. These are some of the major indices. You can also trade these via the cash market and via the futures markets. So the benefit of trading via the future markets is that you need less capitalization to trade them, because it tends to be a larger capitalization to trade them via their plain vanilla indices. So one of the ways that equity markets impact currencies is like this. When the market is worried, money moves from riskier assets like equities into less riskier assets like bonds. So remember I said equities are more risky. They offer a higher rate of return. So when the market's feeling worried, when the market's feeling nervous, what you tend to see is equities falling, okay? So this is how it impacts currencies. If you get heavy equity markets falling, you tend to see the following dynamics. Particularly during COVID-19, you saw Japanese yen, Swiss franc strength, US dollar strength, and gold is usually bought. It's not at the moment, so I'm going to cross that out, but don't worry about it. It's a slightly more nuanced reason. Just keep this. Japanese yen, Swiss franc, and US dollar tend to rise when you have equities falling, when you have bond markets rising. You will see these currencies rising, and you will see these currencies falling. Remember, these currencies are called the commodity currencies. One moment, I'm just going to let my cat out. There we go. That's my cat. That's my trading colleague at the moment. The New Zealand dollar, Canadian dollar, and Australian dollar, they are all sold in a risk-off market. So at the moment, let me show you how I analyze the markets, and I'll show you what's going on right now as we speak. I'll just go and give you some live analysis. This is analysis that I do every day when I want to see what's going on. So first of all, let me look at the US futures markets. I can see that futures markets, medium term, they're well supported to the upside. I told you I'm long. At the moment, in this very, very moment here, we're seeing some pressure in US futures markets. You see a little bit of pressure that's come in on the day. Then we look at bond markets, and we see that bond yields are moving a little bit lower on the day. See Canadian government bonds a little bit lower, a little bit of pressure in Germany, a little bit of pressure in the UK, a little bit of pressure in US government bonds, New Zealand bonds sideways. So taken as a whole, there's a little bit of pressure in the bond market. Looking at the commodities markets, okay, we can see pressure in gold, pressure in the oil complex, WTI crude, Brent crude. There's also pressure in copper, pressure in silver. Taken as a whole, we've got weakness in the commodity markets. Then looking at currencies, we can see, oh look, we got weakness in the Australian dollar, CAD, New Zealand dollar, broad weakness across the commodity-based currencies, and we've got broad strength in the safe havens, the yen, the Swiss franc, and the US dollar. So that tells me right now, the market is biased towards risk-off trading, okay? So in a risk-off trading for right now, for intraday trading, what you'll be looking for is the following moves. I'll just show you. So you'll be looking at the yen, Swiss franc, US dollar rising, New Zealand dollar, CAD, and Australian dollar selling. So you might potentially look at Aussie US dollar short, Aussie yen short, CAD US dollar short, which would be a US dollar CAD long. These are the kind of ways that you would looking at trading it, and this is how commodities and indices impact the currency markets. I've given you a very, very lightning tour on that. These are concepts that do take traders a long time to master. If you haven't understood bonds, that in itself is a concept that can take a good few weeks to understand. And these are concepts that I spend a lot of time teaching, as you can imagine. Helpful correlation to mind is that the Nikkei 225, that's the major index out of Japan, and the Japanese yen are inversely correlated. When the Nikkei falls, the yen rises. When the Nikkei is rising, Japanese yen is falling, okay? So you can see here that when you have a falling Japanese yen, you see a rising Nikkei and vice versa. So that's a key correlation to be looking at. And you can check the Nikkei for a quick proxy for risk sentiment. Sometimes the Nikkei is just a handy short-term tool to look at. And when we see risk-on trading, when we see equities rising, we tend to see the exact opposite. Yen, Swiss franc are sold alongside the US dollar, New Zealand dollar, CAD, and Australian dollar are bought. That's kind of the way it works. So in a risk-off environment, the currencies we should look to buy are currencies like the yen and the Swiss franc, and we should look to sell New Zealand dollar, Australian dollar, CAD. So Maria, in a risk-off environment, you would be selling Aussie yen, selling New Zealand dollar yen, Aussie Swiss franc, New Zealand dollar. These would be like, you know, key currencies to be selling in a risk-off environment, okay? The one currency that's a good kind of indicator for global risk is the Australian dollar, Japanese yen. When that's rising, the world's optimistic. When that's falling, the world's more pessimistic. So that's quite a handy little tool to be looking at. And then finally, I thought I'd close on one of the trades that I took before we do a question and answer session for the last few minutes of our time together. This is some currency trading that I'm doing at the moment. It's called headline news trading. Professional traders, they have access to a professional news score, which is literally someone talking out the news. And what I'm looking for is I'm following Bloomberg. I'm a Bloomberg terminal, I've got the Reuters terminal, and I'm looking for any Brexit headlines. And December the 3rd, last week, we saw a squawk, some news came out over the squawk. Sounds like Brexit talks have gone worse this afternoon. A senior government says at the 11th hour, the EU is bringing new elements into the negotiation. A breakthrough is still possible, but that prospect is receding. So immediately, I was expecting pound weakness, and you can see that I took my first trade out here, and I opened here, closed it there, had a second trade running at break even, and I closed that out the following day. So just showing you the sort of trades that I take. Headline trading is a skill in itself. You could actually have an hour or 2 hours seminar just on the skills involved in headline news trading. Can be very profitable when done well, can be a real pain when done badly. So that is a final little, little bit of insight to make it more interesting for you, especially for you guys. That was a trade I took December the 3rd, just when I was finally preparing for this webinar. So I'd like to say thank you very much for having me. I will be passing on some information to Megha, explaining, more access to my resources. I have a blog which I run every single day. So if you're looking at anything, I'm constantly analyzing the markets, and I'm running free webinars, etc., from my blog, and I update that every single day. I will send that to you in the chat box so you can follow that along. And I hope you found this helpful. I've really enjoyed explaining it. I love teaching people to trade. Trading is very difficult, but it is a skill that can be learned by anyone. So if you think you can trade, you almost certainly can if you're prepared to put in the commitment and the time for learning. And it can be a fantastic way of supplementing your income over a number of years. It does take time to learn to trade. It is a skill, and it's one of those skills, a bit like being a dentist or a surgeon, is you're always learning more, you're always learning, and it's something you have to commit yourself to. Great, thank you very much. Do I have, I'll go to the question and answer session now. Oh, good, Ghazala, thank you. Pragaba, Ghazala, I'm glad you said that's been interesting and helpful. That's always good for me to hear. So if you have found it helpful, please do let me know. I'm going to go through the questions now. Abdul, how can a beginner start trading in the currency market, the basic steps? The first thing you need to do, Abdul, is you need to get some training, okay? You don't want to start trading the currency markets without having some training. That training takes time. I do run some programs. You can speak to Megha and you can ask her. I will send some details to Megha about some of the training courses I do run. Don't try it yourself and just get stuck in, because the danger is you will lose money. And you have to be very careful when you're starting and learning to trade that you don't lose money, because it's very easy to do. So you need to get some coaching, Abdul, in order to learn. The concepts that I've taught you, they take years to learn, and you need someone with you regularly. So I have been able to set up a program that gives a good framework for helping people to learn. So please do contact Megha. Bhagav, does it depend on import and export of commodities? Yes, import, exports of commodities, supply and demand is very important. So I'll show you something here. Let me just I'll show you here something on platinum. So this is on my blog. I'll show you here, and if you look, you can follow this insight, and you can see what happened to platinum prices afterwards. Okay, so Bangov, this is for you. I'm just going to send you this link. Okay, and there's the blog link there, and I'll show you how I go to analyzing commodities like platinum. This was another trade I took, and I didn't make as much profit from this as I should have done. And a very important lesson here is I found this a bit of analysis. You can read this, and anyway, it's for another time. Okay, Tony, what's the difference between currency trading and binary options? So Tony, often currency trading is when you're trading the spot movement of price. So if the price moves down 50 ticks or 50 ticks up in currency trading, you're losing or gaining tick by tick. Options is when you can sort of hedge in some of those positions, and you can limit your losses a lot more easily in options traders. So option is kind of, you're basically sealing in a right to potentially sell your option at a predetermined price in the future. So at the moment, Tony, what's happening is you can see here, let me show you. I'll show you a good example of this, right? I'll show you some option traders in the pound. Right, let me just share the screen. This will demonstrate it nicely. Okay, if you look here, what you can see is that this risk reversal, this blue and the purple line, is dropping, and we're seeing that the options volatility line is going up. This is for the pound. So what's happening here, Tony, is that option interests are growing. So since about June or July, pound traders have been buying the pound, expecting a EU-UK trade deal. They're now purchasing options in case there isn't. And so the option is a way of hedging your currency moves. The bottom line is options of preference to currencies when you think there's going to be a lot of volatility. So if you think prices are going to have huge swings, you go to the options market because it's much easier to limit your risk. And it's a way of kind of sealing in a price in the future that you can use. And that's the way that options traders, it's kind of a topic in and of itself. But the main option is to do with the reason traders use it is to try to limit the volatility of a spot position. I hope some of that helps, Tony. I haven't made that as clear as it ought to be, but I hope you get a bit of a feel for it. I run individual training sessions, and I do have a support network. I don't have a course as such, although I do travel to Dubai. I have been traveling to Dubai about 5 times a year. And I do run a beginner's trading course in Dubai. Again, maybe I can speak to our support here and make sure we get the details sent over to Megha for the next one. Haven't been doing it, Kevin, because of the coronavirus. So I miss not coming over. Yes, yeah, okay, Tony. Yeah, stock markets move. There's a limit up and a limit down. And during the COVID-19 crisis, stock markets will move according to a limit. So it's something like 7%, and then trading stops for half an hour. The idea is to stop, ridiculous moves happening. That's why stock markets will close during times of intense crisis. Of course, that can be very painful if you are caught in that market and you can't get out. You limit up or limit down. It's just a nightmare if that has ever happened to you. Oh, Maria, that's great. Yeah, thank you very much. I'm very glad that that's been helpful, Maria. Yeah, how did you feel when you started trading? Very excited, Gabrielle. I found it very exciting to see the way that price moved and I really found it fascinating when I first started trading. At first, I was very frustrated when I started trading as well, because I learned to trade originally from a retail perspective. And so it was very difficult for me to learn to trade, but I persevered through it, and obviously have come out the other side. So I really, really enjoy it now, more so than when I started, because now I know what I'm doing, whereas when I first started, I didn't know. Yara, that's good. Okay, that's excellent. Okay, well, I've just run 5 minutes over, but I wanted to answer your questions. Thank you very much for having me. I will now hand back to Megha, and thank you very much. It's been a pleasure to meet you all, and I do hope that I can meet some of you in person in the future, next time I'm in Dubai. And do feel free to contact me with any questions. You can always link up with me on LinkedIn, and I'm very happy to connect and stay in touch with people and help them on their journey any way that I can. Thank you very much.
Thank you very much, Giles, for this insightful session. Seriously, there was so much learning in just this last 1 hour. So thank you so much for your time. And, please share details about your courses and all of that. Webinars that you run, I will share it with all the participants here so they can continue to interact with you and reach out to you if they have any more questions. And yeah, thank you so much for your time today. You have a lovely day. And thank you.
Thank you very much. Thank you, everybody. Goodbye.
Thank you. Bye-bye.